In overtime, tech stocks under pressure again today. The Nasdaq now down nearly 23% this year. Our next guest, though, is betting on a turnaround coming as we head into the back half of the year. Joining us now is Tom Lee. He is the head of research at Fundstrat, of course, a CNBC contributor as well, and he made his way to Post 9. It's good to see you.
Great to see you, Scott.
You sat down, you said, I'm feeling better about this market. And why are you feeling better? Because there are a lot of issues out there, Tom.
That's right. I know the Fed's got a tough job, and I think all of our clients are just watching inflation prints and nervous about Friday. But it looks like a lot of things are happening around the economy in the world that are helping the Fed. And I think one of those is that I think there's a lot of goods that are going to start seeing discounts, both cars and apparel, furniture, everything Target and Walmart have. And now I think housing is cooling pretty dramatically, and that's going to lead to both job loss and some wealth effect. And so I think the Fed has the market doing its work for it, which means investors don't have to worry about hawkish surprises.
Still sticking to your choppy now, but strong second half of the year, and we can reach some levels that look, at times unattainable, to be frank.
Yeah, that's right. I think a lot of folks think, hey, look, the S&P won't see 4,800 again for 5 years, but we have to realize there's some bullish themes really coming together. One is the labor market is creating wage pressures, and that's solved with technology and automation. That's great for tech. I think eventually the war ends with Russia and Ukraine, and then we have a post-construction build and commodity prices fall. That's really good for U.S. companies. And now that stocks have come in, tech is cheaper than it was in 2003 after the dot-com, and there's been a real loss of faith in owning some of these names that are important. So I think there's a lot of upside surprise. You
don't have any concerns whatsoever about oil pushing towards $130, nat gas pushing towards $10. We can stop there, but then I would continue and say the very stocks that you like so much, these large cap technology stocks, earnings are, I feel like, suddenly in question. Microsoft told you what they did. There are now concerns about what Apple might deliver as a result of the services business. Intel, not that they're in the same ballpark, obviously, as Microsoft and Apple, but you catch my drift.
Yeah, I do. Nobody wants earnings cuts. I think that feels like it's another leg down for folks. But I think the surge in oil is almost a barometer of the progress of the war. So I think as long as there's war, the OECD had a great report today showing that half of the inflation surge this year is really war-related. And once the war comes to a conclusion, I think we see oil and food prices really start to disinflate. But it's painful now. I don't think that means tech has downside. If we have estimate cuts, but a lot of it's priced in, then it's just a risk-reward question.